Stay tuned for Retire Your Way with Dale Sudis, a leading financial retirement strategist and the founder of Sudis Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Sudis. That's right, friends. This is Retire Your Way with Dale Sudis of Sudis Financial right here in California. If you'd like to learn more about the team while we're doing the program, you can go to Sudis.com, SOUTAS.com. Mr. Dale Sudis. Of course, the crowd excited to have you here. Are you excited to be here? How you doing? How you doing this week?
Oh, yeah, I'm so excited. I was just clapping too. Yeah, sure.
Live is busy. I'm going to talk about some record-breaking kind of numbers that are happening in the industry. You're, in fact, yourself kind of having some record-breaking numbers. More and more and more people are listening to the radio show, coming to your live events, calling you. Dale, are you a little tired?
Lately, yes, I've been a little bit tired. No, but it's a good tired. I mean, it feels good helping people, working with people. I want to, I liked how you brought out to get to know us, go to the website, really even to get to know me a little better, see what I went through, as a little one, a baby on up, to understand my thinking and how I look at the ones we work with, how we kind of adopt you into our family and how we want you to feel about your future. There's just a short little 4-minute video that I tell my little story about going through 4 different body casts. If that doesn't pique your curiosity to jump and look at that Sudis.com website, I don't know what will. But check it out so you understand, what we're about. Or find out when our next event is at Fresno State. We do them every other month. And
those are on the website as well. We update that. Sudis.com, SOUTAS.com. We also see all of the phone calls coming in as well. We're going to talk about how do you keep yourself from risk. So we hear this phrase a lot in the industry, mitigating risk. I'm not a big fan, though, of jargon. There's different kinds of risk factors. But first, if you don't mind, the beginning here of the program, we can kind of talk about portfolio risk. I think that's what people think when they're talking about risk. How much risk should I be in as I'm getting closer to retirement? Why it's not as important about how much risk I'm in earlier.
Right. They think of like stock market risk, when you say risk, but there's a lot of other risks that you need to be aware of.
Yeah. So we're going to talk completely throughout today's program. How do you mitigate risk in all different facets of your financial life, including longevity? We'll talk a little bit later in the program about taxes, but I wonder, now this is supposed to be the good and the bad of capitalism, right? Your dollar is kind of your vote. And this is really interesting to me, Dale, because for the last 3 years, people's dollars are voting on a tool that oftentimes has an emotional reaction. Reporting now for the 3rd year in a row, U.S. annuity sales in the first quarter of this year, because it takes them a little bit of time to get this reporting done. So the first quarter of this year were $113.5 billion in 2024. That's 21% higher than the year before. That was a record-breaking year. Last year was higher than the year before that as a record-breaking year. Dale, people are clamoring for annuities. What's going on?
Well, could be a lot of things, but people are actually getting the clear understanding of what they are and how they fit in to, solidify their retirement, how to make sure their income plan could be basically poured in concrete, so to speak. In other words, they can set up annuities to give them additional guaranteed lifetime income. So, but many times ones don't want you to, use annuities. They think we can just take money out of your portfolio at a certain percentage and, your portfolio grow. But that doesn't always work. And you don't want to have to tighten your belt because now the market's down or something like that. You want steady income to pay the bills. You want steady income to go out and goof off and do the fun things you've been wanting to do or do more of when you stop working. So annuities give you that, as well as the right type of annuities can give you safety of the principal, whereas it can still give you good returns without any, stock market risk.
And is this what people are doing on their own to kind of, I guess, mitigate the risk of keeping their life savings in some sort of investment account? Or are there percentages that you prefer before using a tool like this? Is this tool an annuity right now with, again, record-breaking billions of sales going into them? This is reporting through LIMRA. First quarter of the year, individual annuity sales. This isn't even the different types, but the numbers support the fact that Americans on their own are looking for their own income plan that they can't run out of. They're driving themselves over to there. Would you say thumbs up on these statistics? Is this good?
Well, yeah, it shows that people are wising up, so to speak, understanding the benefit of them. And, like I've said before, the three basic types, you have a variable annuity where it can go up and down with the stock market, and they tend to have the high fees because you have the guarantees and income producing features of the insurance contract. So there's some fees for that. Then you have your investment fees. So sometimes you can have, 3 to 7% or more fees per year on those variable annuity contracts, which we choose not to use. Then you have an annuity where you could just give an insurance company a chunk of money and they give you guaranteed income, no fees on this at all. They give you guarantee income for a set number of years or for life or for joint life, a variety of ways you can have it set up. Those have their place. And then you have fixed annuities. Again, no fees on a fixed annuity. It's like, compare it to a CD. You put $100,000 into a CD at the bank, you get a guaranteed rate for that period of time, months or a year, whatever time you set it up for. A fixed annuity works similarly. It's just with a life insurance company, not with a bank. A fixed index, instead of giving you a fixed rate, they just buy options on an index. None of your money touches that index, like the S&P 500 or the Dow Jones or the whatever, PIMCO, different indexes. And if the index goes up, you can benefit by the upside. But when the index goes down, you don't take any of the losses. So you can go up with the market without going down. Some of those might have fees depending on the additional benefits that you attach to it, like they call them riders. But the point is, why is even the government in some of the new legislation about retirement accounts recommending annuities? Mm-hmm. Why are they doing that? People, if you don't understand, if you start Social Security, what are you getting? It's a guaranteed lifetime annuity. If you worked for a company for years and you get a pension, what is that? It's a guaranteed lifetime annuity. So the lump of money, whatever you've accumulated with Social Security and or with the company, it's annuitized. You are the annuitant, the recipient of the payments. So it's annuitized, and they give you income for the rest of your life. You could set up for just you or you and your spouse. There's a lot of various options that way. So you could set up your own. You saved and saved because more and more companies are not providing a pension. You get 401ks, 403bs. And so what you do there, you can actually create your own private pension, but you don't need to use all of your savings to do that. So that's the beauty of it. But if you do use a portion of your savings to set up additional guaranteed lifetime income so that now you can pay the bills ongoing rest of your life, including inflation. You have ability to play. You have a play check, as we call it, and even a care check down the road to keep you out of a nursing home. If you have it dialed in, the rest of your money, if you like playing the stock market, you can without any worries about that money because your income is set. You know you're not going to run out of money to pay the bills. And that's a good feeling if you think about it.
A couple of reminders for our listeners out there, or especially if you're brand new right now, talking about a tool like the annuity isn't something that Dale solely does. We also look at the investment assets, we call it AUM, assets under management. Not everything needs to go into a tool like this. In fact, not everyone needs to have a tool like an annuity, but we're just talking about the fact that mitigating risk, more Americans today are looking for tools. There's over $113 billion just in the first quarter of this year that went into annuity sales from individual Americans going, I want some version of guaranteed income in my lifetime. That doesn't mean that's all of their life savings. It's a portion of it, perhaps. Now, we know how Dale does things, and so we can help you review, find out what's best for you. But if you're trying to create an income plan, if you're trying to figure out how do you mitigate risk, as the industry likes to say, how do you protect yourself from risk while having a little bit of growth? Why don't you come in, sit down with us? This is what we do every day in the office. Dial the phone number, 833-856-1382. We have people standing by. We'll schedule an appointment, and you can sit down with Dale and his team for your discovery meeting to find out how we might be able to help you. When we get back, I'm going to ask you, why do losses affect us so much differently as we're getting nearer to retirement in the market, losses in the market, as opposed to when we're younger, when people say that's actually a good thing when you see losses in the market. So more with Dale Sudas, mitigating risk, in today's program. When we get back right after this, 833-856-1382 is the phone number. We'll be right back.
How do you know if you're retirement ready? That's a question many people ask themselves as they approach their golden years. We believe the answer can be complex and depends on many factors, such as your savings, monthly expenses, and lifestyle goals. At Sudas Financial, we can help you determine if you're retirement ready. We'll work with you to assess your financial situation, identify any potential income gaps, and develop a customized plan that aligns with your goals. Don't leave your retirement to chance. Call us today to learn how we can help you work towards achieving financial security and peace of mind in retirement. Call Dale Sudas and the team at Sudas Financial for your complimentary retirement readiness review. Call 833-856-1382. That's 833-856-1382.
For those approaching and in retirement, the perfect economic storm has arrived. The highest inflation in over 4 decades, the end to the 13-year bull run of the stock market, looming increases in tax rates, and rising interest rates all spell trouble for your retirement savings. At Sudas Financial and Insurance Services, our mission is to provide you a clear income path that lasts all the way through your retirement years, no matter what storms are ahead. Call Dale Sudas and Sudas Financial right now for your own complimentary retirement storm strategy. 833-856-1382.
For your own custom complimentary Retire Your Way review, call 833-856-1382. That's 833-856-1382.
This is Retire Your Way with Dale Sudas of Sudas Financial right here in California. How do you protect yourself from the risks of the up and downs of the market? It's a phrase called mitigating risk. But mitigating risk doesn't just have to do with your portfolio. Stick around throughout the entire show. We're going to talk about mitigating tax risk, mitigating the risks of, making sure that you don't outlive your money, called longevity risk. But we were kind of on portfolios and ways that people kind of mitigate risk. Now, Dale, we were talking about a tool. Again, maybe you could explain in your own words. When do you implement an annuity, and what is maybe the overall process? Is there also the asset management? Let's hear it from your words.
Well, on a discovery visit, we're just mainly wanting to find out what you're all about. What are your priorities? What are your goals? What do you want to do or do more of when you retire? Or if you're already retired, I like asking this question of everyone who comes in. If money's not a concern at all to you, what would you really want to be doing or doing more of? And why is that the hardest question for people? I mean, many times, that little question's blank on a little form, a little half sheet they fill out when they come in, It's like, well, what makes you tick? What do you like to do? I mean, I could tell you all about my hobbies. I like a bunch of things, but what do you like to do? Because sometimes people are so busy working. They're busy, they're raising the kids. Now they're saving for retirement and they're working hard and they don't do much of anything but work, come home, relax in front of the TV with each other, whatever, and then you go to bed and start another day, right? So, I like knowing what, number one, you want to do. Then I want to show you how to do it or do more of it. Sometimes people say, well, we really like taking trips, and it costs probably for the two of us $10,000 for a trip. And we want to budget 2 of those a year. Well, what if I show you how to do 3 or 4 of them a year without your money running out, without your income, without having to tighten your belt and all that, would that be okay too? Well, yeah, obviously. So then I look at, well, what is your current income? What's your projected income from Social Security and or pensions and things like that? You have rental income, factor that all in. What other assets do you have? Roughly ballpark. What do you have in the bank? What do you have invested? What do you have in retirement accounts? Once I see that whole picture, then what do you need to pay your bills month in, month out? And sometimes people they're not sure exactly. So we have a simple form they can take home, and it breaks down things that they might not be thinking of that they do have to pay for, even though maybe they get the bill every 6 or 12 months, right? So we factor that all in, and we see that here's their monthly budget, the things you want to do. Okay, that's your play check. We know how to calculate for way down the road if you need care to keep you out of a nursing home. So we build all that into a plan. Sometimes, it's just keep your money the way it is, or maybe you put some money under management, which basically means, it's liquid. It can go up and down with the market, but we want to make that a kiddie ride, not a scary roller coaster ride like what's the one at Santa Cruz, the Big Dipper they call that the old anyway, it's a Big Dipper roller coaster. No, we want a smooth ride. How do we smooth it out? Sometimes we need to put a portion of their money into a vehicle that either right away or in a few years they can create additional guaranteed lifetime income and take the pressure off of pulling from their investments, right? So obviously that would be an annuity. But it's just a matter, everybody's different. So that's why these typical rules people, hear, like the 4% rule or
the
that
rule of
100,
100
yeah.
stuff.
It's like, come on, no,
And just for our listeners, real quick, just to give the 4% rule, that's one that's been out there. We've talked about it before, but it's that, if you have, so here's the thing. The people always remember the 4%, but they don't remember necessarily what the parameters were. The 4% rule was based on the fact if you have $1 million in invested savings,
right,
and it averages, I think, something like 7 or 8% a year in returns, you should be able to draw 4% out of it in a 30-year retirement and not run out of money. Now, there's a lot of that's a lot of speculation in there, because I don't even know if they took into account things like, what is your tax bracket? Was that in a tax deferred account? Are you just talking $1 million based just straight on math and numbers? The rule of 100 is that you're supposed to subtract your age from 100, and that's your risk tolerance. Those things, they're great in print, and they're great for somebody selling a book. They're cute. Yeah, it gives you kind of an idea. Yeah. But is that how you do the math in the office?
No. In fact, in our live events, we actually give some real examples of that roughly 4% rule. If you had $1 million and you take 40,000 out a year, but your money's fluctuating with the stock market, I mean, you're taking 40,000 out. When the market's up, no big deal. You don't have to sell as much of your investments to get that 40,000. But when the market's down, you got to sell more shares, more of your investment to get that 40,000. And Texas Tech did a study on that years ago and showed that 4% rule fails more than half the time. Your money can run out. The sequence of returns.
I got to look that up. I'm going to look that up for the Texas Tech study on the 4% rule. I'm going to look that one up.
Yeah.
Oh, and just to throw this out there for our listeners as well, if you've never heard it before, there was one person who actually said the 4% rule, it can work unless you're in high inflationary times. And the person who said that was the person who wrote the book on the 4% rule. And he was the one who amended it a few years ago. We're going, wait a second, please don't take my 4%. Because if you got high inflation, that's really going to
it's not keeping up.
Yeah,
if you're taking the same amount, how do you build inflation in? So there's tools that can, there's one company I love because they have an income feature on the account. It's a fixed index annuity, and basically once you turn the income on, the income can actually increase and never go down again based on if the indexes go up, you can get, increased income, and that's for life. And so that's nice. It's kind of like people have pensions with a COLA or Social Security that has occasionally an increase. What did it have in 24? 3.2%. I like the ability to have increasing income through retirement as well.
Yeah. I know that people like to listen to your programs and come to your live events so they can hear real life examples. Talk to me about somebody who you've helped recently, who is somebody who wanted to mitigate their own risk.
Well, actually, yeah, I've known her for a long time. She has excellent income, and she's got a pension. She got Social Security. She has rental properties. Recently, she sold one of her rental properties, and after tax and all that, she had a chunk of money. And I said, well, what do you want it to do? Well, I want it to keep it safe. It'd be nice if it grows. Basically, she knows it's probably just going to the kids. So, I'm not even using an annuity for the purpose of future income, but I am using one that gives her safety of her principal with decent upside potential. So, we set up some money that way. So she knows that money's safe. It can only go up with the indexes through the years. It can't go down.
Now,
there's some neat features to it.
I don't mean to interrupt you. Was there risk in real estate? I mean, okay, we've seen the markets and what they did in like 2008, but I mean, was that a risky asset class that she was mitigating?
When she came in just, recently, to go over the new contract from that we set up, she told me that her other property, they just gave her notice that they're moving out, but they've been there over 10 years. So it was like, she was counting, and that's more like guaranteed income in a sense, not that it's really guaranteed, but she knows now at her age that,
is she taking care of the properties herself? Is she doing the cleaning and the yard work? And so she's almost
single.
So she's mitigating the risk of caring for the real estate of the properties.
Yeah, and she's shy of 80 a little bit. And so I said, well, you do have a outfit or crew that helps you clean the property after people move out and all that. And she goes, oh, no, it's me. And I'm like, you're kidding.
That is a lot of work.
No, so I told her, if you need help, I know people who we can call on to get some extra help.
Now, this is a very, very fortunate person out there. There might be some folks who listen to the beginning of the story. He has a nice Social Security, has a pension plan. There aren't a lot of folks out there who have that. But just in thinking of real estate alone as something, especially if it's a rental or maybe even part of your business and you're wondering when you sell all of that, do you sell the property? Using that to create the income. I mean, yes, we've seen how real estate has grown, but then you always say this as well. What is the purpose of your money, or what is the purpose of that asset? If the idea of the real estate was to let it grow so you can create income later, the passive income of having that rental income, don't forget all of the upkeep, you taking care of it. And like you say, Dale, every situation is different. But as we're coming up on 80, do you want to be taking care of that property?
Yeah. Do you want to be the landlord? So, but I have ones, and they're younger, and they have multiple rental properties, and they manage it with no hiccups, no problems. But really, when you really boil it down, though, think about it. The real money in a piece of rental property is when you eventually sell it, because you bought it for, this little bit, years ago. It's grown, and you sell it down the road for a bigger gain. And that's capital gains. There's some tax on that, but the capital gains tax rate is lower than ordinary income tax rate, although, it pushes your other income up too. So there's pros and cons. But if you think the rental income is guaranteed, it's not, because if people move out or there's a fire, whatever, things can happen to where you don't have that income.
And home insurance costs. I mean, you're always going to have insurance on your properties.
Taxes,
things go up over time.
Yeah.
But you know what? Again, let's sit down with a financial advisor, determine what is the goal of your assets. It's not just continued growth. If it's to provide you an income, maybe you've already won, maybe you've already done it right. Now let's see how we can turn that into income that you can't run out of in your retirement years. Call the phone number right now. People are standing by to schedule your appointment with Dale. No cost, no obligation, no pitching, no sales, no nothing. Just come in. Let's have a conversation. Figure out what you want to do in retirement. 833-856-1382. That's 833-856-1382. If you're the one driving the car, give that number to your passenger right now. Have them at least dial it. Put it in the phone so you know where to find us later. More Retire Your Way with Dale Sudas right after this. Call Dale Sudis and Sudis Financial and Insurance Solutions right now to receive your complimentary tax map with your retirement readiness review. Learn multiple strategies that could protect you from higher taxes now and in the future. Taxes are a threat to your financial stability in retirement, so help protect yourself from the potential threat of rising taxes. Call Dale Sudis and the team at Sudis Financial to receive your complimentary tax map and retirement readiness review. 833-856-1382. Their team will help you navigate the financial waters to pursue your retirement goals. They offer inclusive retirement services such as investment directives for your portfolio, income-producing strategies, and wealth preservation plans for your family and legacy. Call Dale Sudis and the team of Sudis Financial and Insurance Solutions, 833-856-1382 right now for your retirement readiness review, and also receive your complimentary tax map. Strategies to help you keep more of what you've saved in retirement. Or write us at the email address dale@soutas.com.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Sudis Financial, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Sudis Financial will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Sudis Financial. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Dale Sudis and the team at Sudis Financial to get started on your own complimentary written financial plan. Call 833-856-1382. That's 833-856-1382. Get your comprehensive, complimentary Retire Your Way review by calling 833-856-1382. That's 833-856-1382.
This is Retire Your Way with Dale Sudis of Sudis Financial. You can get your own complete written financial plan started right here with the team. No cost to you, just as being one of our radio listeners. Call the phone number right now, 833-856-1382. We have people standing by. They'll schedule your appointment, and you can come and talk to Dale about your own financial plan for retirement. We're talking about mitigating risks. We move a little bit out from the markets. We realize that we want to mitigate risk because of the ups and downs of what happens with our markets. But another version, though, of mitigating risk is, you say, longevity risk, living longer. A story I believe we talked about a couple of weeks ago was this woman in Houston who just had her 115th birthday. There's only two other people on the planet living older than her, 116 and 117. But what I thought was funny about this was that she lives with her very young, sprightly little daughter of 94 years old. How do you know if you got longevity in your family, Dale? How do you plan for living to 100?
Yeah, I adopt the older one, so I know I'll live longer. That's how I do it. Yeah. No, I've had several. They're in their mid to late 90s. I've had, almost a handful that have passed 90s, got into their early 100s. And,
Amazing.
some of the old... it's interesting. I set up somebody. I said, okay, this is an account that keeps your money safe, keeps it growing. And then the old contracts at age 100, they had to pay out the contract. And it was like, you're 100. Yeah, you got to take the money now. And we had to find a different place to put it. Typically at that stage, it's put it in the bank, keep it safe, and keep it available. But yeah, people are living longer. And so if you think about it, when you live longer, that what's called longevity risk, what does that do to inflation?
Yeah.
Well, it means things are going to cost more for longer. What does it do to taxes? Anybody thinking tax rates are going to go down over the next 10, 20 years, okay, stay in that world because likely they're not. So, things go up.
Let's give some real backdrop to that inflation. Let's home insurance, auto insurance. We know what's happening here in California. Some people's insurances are doubling and tripling. I've seen that. You've witnessed it. Things like buying an automobile. You were discussing that. Should we be buying an automobile later in life? What do you think?
Right. So here, typically I work with families, and unfortunately the husband dies. Typically, statistically, you women wear us out, right? So you live longer statistically.
I take no part in that jab.
I thought you told me that one.
No.
Oh, no. Okay, but anyway, we know statistically women outlive men. So I have a lot of little ladies. They're like moms to me, right? And they call me son, I call them mom. And so now it comes a point they don't have the husband anymore to say, well, what should we do about this or that or the other? It could be, should we sell the house and downsize? Should we get a new car? It's just stuff. It could be something simple like, he used to handle where we get our car serviced. Well, I know places that you can trust. They won't play games with you. Whatever, I'm like their adopted son, and I coach them through, if they stump me, I've got ones to ask. So that helps. But it's just a matter of, people are living longer. So what do you do? I mean, groceries are going up. I mean, I get that regularly lately too. I've had people say, the cost of everything is so much higher. Well, yeah, it's the way things tend to go.
If we're early in retirement right now, and you are starting to see that, like you decided to retire 2 years ago, 3 years ago, 4 years ago. You said, I want to get out. The technology is getting to me, or I've done enough. I feel like I've saved enough. And you're worried about that kind of longevity. Is it too late? Are there things you can do to review for people who are already 2 or 3 years into retirement?
Yes, exactly. Especially if you're retired and you don't really have a clear understanding or a clear retirement income plan, you need one. Have it reviewed. The real reason, think about it. I don't want you to live a just-in-case retirement, as they call it. A lot of people say, okay, when I retire, let's say I want to buy the boat, I want to join the country club, I want to travel, I want to do these things, right? And then they retire, their money grows and grows and grows, they don't do anything. They die, and the money goes to kids, and what do the kids do? They buy the boat, they join the country club, they travel, they do all those things. Well, no, I want you to be able to do all that, and, there'll be plenty of leftovers for the kids, but, my focus is on you to make sure you're not hoarding your money, because in case something happens, if you have it dialed in properly, and usually it's, well, yeah, but if something health-wise, well, most people in retirement, they've got Medicare and some kind of supplement or some kind of Medicare plan. So that's not going to wipe out their life savings if you're hospitalized and so on. What they're really saying is, what if I need long-term care? I'm stuck in a nursing home, or I need people to come into my home and help me from now on. Yes, that can get very expensive. So that needs to be built into your plan.
Yeah.
You need a paycheck to pay the bills. You need a paycheck to do the fun things. When the play stops, because now you're needing care, you need a care check. And that, when you buy long-term care insurance, what are you actually buying? You're buying, when you need help, you're buying the right to be given some extra income to keep you either at home or hopefully just assisted living and out of a nursing home. But why not build that into your income plan so you don't throw money out the window in case you never need it?
Millions of Americans are struggling with that. And when I say it, I also say to folks like myself, I can't believe I was sitting around at a friend party, so a bunch of old college friends were coming together because somebody who's actually, they had just passed away this past weekend. And they had gone through a version of Alzheimer's as well. And, it used to be you would go around the table and it was sports stories, but everybody had some version of story that was, oh yeah, I'm in town because I'm going to be helping my stepmom. She's transitioning from the house, moving into a care facility. And she's not sure if she's doing the right thing. She's not sure if she should sell the property. Somebody else was talking about, oh yeah, I have to see my dad, at least twice a week. My brothers are sharing it. We're in this situation right now where people are living longer and we're not getting a lot of advice on how to prepare for it, Dale. Folks are struggling on their own.
Regularly, I see people who are, they're still working, but they're trying to care for a parent, let's say. and they're jockeying between both, and they're wearing out faster than their parents at times. What do we do? So if you're listening and you're in California, understand there are programs that we've been helping families with since 1997. That's before I was born, right? I think. So anyway, but there are programs through Medi-Cal, but the programs are different than the typical welfare Medi-Cal programs. Different rules, different funding. So right now you have a loved one who needs help, with getting up and down or bathing or dressing, or cognitively it's not good to be even leaving them alone. The Medi-Cal program now, they don't even look at what you have in the bank or your properties, the assets. There's no more worry about so-called spend down, because they don't even look at your assets anymore. They only look at income. So many are surprised that we can get help to even pay a family member, or better yet, to pay others who are qualified to come in and give the family members a break so that your loved ones can stay at home. Or if they're in some kind of assisted living, which ones work with these programs that can help pay for those without using whole dollars out of their savings, right? So there's a lot of things like that we help people with. It's one of those things, like we said last week, you don't know what you don't know. So there's a lot of neat programs that can usually be activated to take the strain off the family.
And that's as far as the information. You don't know what you don't know, and it can be overwhelming searching and finding on your own. You have team members who can help you. Dale, you've done it for a long time. But what we are starting to find out is that the you don't know what you don't know, we're all starting to share stories of either someone in our family or friends, somebody we know who has gone through something like this. And when you're going to work and you're trying to save for your retirement and you love your aging family member, whoever that might be, it becomes not just the financial possible drain, the emotional drain, the time drain, and just spending that many years. And look, living to our 90s, living to our early hundreds, yes, that is something to celebrate. But let's have a plan for it as well. Let's make sure, what is that phrase? They say that nobody wants to be a burden on their family. And I think we have to get beyond being too jokey of saying, oh, don't worry, my kids will take care of me. Ooh, that could be for a very long time, Dale, right?
Yeah, it could be hard. So, again, and understand it doesn't cost a dime to know your rights and options, know about the different programs, and even ahead of time. We used to years ago put on little workshops at the Ramada Inn down the street in Fresno and just educate people about the long-term care options alone. So those are things, if you want to know, it never costs a dime to come in, even to have everything looked at, all the ins and outs of your income plan, loved ones care plan, all of that can be looked at. And sorry, don't bring your checkbook. We're not gonna. You're not gonna
no
write
pitching,
us a check.
No selling. If you're curious, if you have enough saved, not just for yourself, but possibly for your spouse, if one of you needs to go into long-term care, yes, there are wonderful programs here in the state of California, but we've got to make sure that you can be allowed into that program. There's differences in different counties, I've even learned from talking with you before. So let's find out if you are covered with your savings. It's better to know, and let's find out if there's something we can do about it. 833-856-1382. It's just a phone call to set up an appointment. No cost, no obligation, no pitching. Let's make sure you're covered for a long retirement. More with Dale Sudas right after this.
Will I run out of money in retirement? That's a hard question to answer if you've never been retired. How do you grow your investments without taking too much risk, but also considering what you'll pay in taxes? Should you convert your tax-deferred accounts into Roth accounts for tax-free growth later? Don't forget about inflation. Instead of questions about your retirement, turn to answers and solutions. Call and ask for your own complimentary retirement solution review. 833-856-1382. That's 833-856-1382 for your complimentary retirement solution review.
Do you know how you'll generate income from your investments along with your Social Security in retirement? In our opinion, it's never too early to start the income planning process for your future. An income plan can help you work towards creating a steady stream of income to support you throughout your retirement years. Don't leave your financial future to chance. Take control today and start income planning for your retirement. Call the team at Sutis Financial so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. Call 833-856-1382. That's 833-856-1382.
As a valued radio listener of Retire Your Way, Dale Sutis and the entire team of retirement professionals at Sutis Financial invite you to schedule your very own complimentary retirement planning session. If you don't have a retirement strategy mapped out that includes low-fee investment elections, tax minimization strategies, decumulation plans from your savings that will last as long as you need them to, then call for your own retirement planning session, complimentary for our valued radio listeners. 833-856-1382. That's 833-856-1382.
To get your complimentary Retire Your Way review, call Dale Sutis of Sutis Financial at 833-856-1382.
Welcome back to Retire Your Way with Dale Sutis of Sutis Financial. We're talking about mitigating risks, and mitigating risk don't just have to do with your portfolio. Longevity risk we were just talking about. Yes, earlier in today's program, we talked about how we can mitigate your portfolio risks using certain tools. But the next one, though, tax risk, taxes as a risk. I mean, we all have to pay our taxes, Dale. Who is somebody who you've helped recently? Again, I think the real life situations help people.
Yeah, exactly. And I don't know. I was thinking of some fun things to say, but let's keep it right to the point.
Okay.
So as a family, it's really neat. Kind of reconnected from many years ago, and very simply, here's a good example. Somebody the mom is in her 90s. I think she's past mid-90s, and she's in a facility. Money's not a problem for mom. Income's not a problem. Able to pay the bills. Okay. But they sold a property they had in the Bay Area, which out there, they go for a little bit more than the ones in the Valley here. So, they had quite a bit of money. And I'm not going to name names, but basically, there are 3 kids. There's let's just say it was $1.5 million. What do we do with this, right? Mm-hmm. And at that age, what are you going to do but put it in the bank, right? But I said, well, look, she's got 3 kids. Why not just share it with the kids? Give them each $500,000. And I'll explain how that works in gifting in excess of the $18,000 per person per year that you might be thinking of.
Yeah, so when you say $500,000, that's not gifting.
That's gifting. It's gifting. And I'll come back to that.
Okay, you better.
So the purpose of that, too, is to help the kids out now, if possible. So... and one of them we're working closely with now for their planning, and they've got some retirement money that's tax deferred. So now they're in a good position, and we're actually starting to do the homework on this very thing of how to start doing Roth conversions, get Uncle Sam out of those IRAs, those tax deferred money now, while we know where tax rates are, which are very low, because most likely tax rates have to go up down the road. I mean, a lot can be said about that, but simply put, the current tax rates are supposed to sunset and start increasing, and who knows?
Let me ask you some details here. So mom is in facility. She's needing the care.
Assisted living.
90s, right? Was she married prior to that? Was this?
Oh, yeah.
Okay, so and we've got
She's
the
a
kids
widow.
here. So here's what I'm guessing. So mid-90s, I'm guessing the kids are probably 50s or 60s? If mom is 90, so when you're saying the kids.
Yeah, the kids are 60s.
Yeah, so we got 60-year-old kids. And so,
Right.
yes, this would be a nice windfall. But how do you give $500,000 to each, and you're calling it gifting? I thought there's big tax implications.
Let's have fun with this.
All right.
Okay, so people hear, you can only give away $10,000 per year. Well, yeah, years ago, that was the gift tax exclusion, which has been going up a little bit every year. This year, 2024, mom can give son or daughter $18,000. Dad can give that same son or daughter an additional $18,000 without having to report the gift to Uncle Sam. That's the exclusion, $18,000. Now, when you gift, in this example, $500,000 to a child, okay, you've exceeded the $18,000, okay? So what you've actually triggered is a reporting requirement. It's not a tax, okay? So follow me for a minute. So she gave this son $500,000. And what he has to do, or excuse me, what mom has to do, she was the giver. Mom has to do with her 2024 tax return next year, she has to prep a gift tax return in addition, with her 1040. Okay. And why does she not have to pay the gift tax? Most people are thinking, well, the recipient pays the gift tax. No, they don't. I'll come back to that. The giver would either have to pay the gift tax or they can lower their federal estate exemption by, in this example, $500,000. So mom can pass away and then her assets that she has an exclusion of, what is it, $13,600,000. So she can pass over $13 million to her kids without any estate taxes. Now that she's given away $1 million, she can only do $12 million. Okay. Or 1.5, she could do, $12 million. You follow? So she's lowering
saying at the end when she passes away. So she's So you're okay. She's taking away the $500,000
from her 13.
From her 13 for the estate tax exclusion later on in life.
$13,600,000 is tax free that she can pass on to her kids. So now she's lowering it by whatever she gifted while she's alive. Okay. So now why don't they have to pay any tax on what mom gave them? Well, number one, they didn't earn it. It's a gift or an inheritance early. Okay. If mom died and that $1.5 million sitting in the bank, earmarked to the 3 kids, they each get $500,000, that would be tax-free as well. So just because she gave it to them now while they're young doesn't mean it's taxable to them any more than if she died and passed it on, as a non-taxable account.
Several years in the industry, listening to folks like yourself, Dale, that's the first time I've ever heard that you can gift, take it away from your estate tax exclusion later in life. Now, how do you actually do that?
The fun part, one of the kids, and if they're listening, they know who I'm talking about. I will not say the names.
No, you can't. I won't let you. Yeah,
his first name's Waldo. His first name's Waldo.
Numbskulls, I'm broadcasting.
I'll cover you on that.
No, I'm not going to say a name. But he's a retired CPA. He understood it very clearly, because the other two were like, "Oh, can you do that?" And I explained it, and he says, "Yep, that's right. That's how it works." So basically, mom and dad today, if they die, they each can pass $13,600,000 to their kids. So $27,200,000 roughly tax free to their kids. Okay. So, and IRS way down the road might lower it to $5 million, but
gifting it now while the kids
can
air
use
quotes,
it.
are in their 60s and they can use it now, plus doing the proficient tax planning, seriously blowing my mind right now, Dale, because I'd never heard anybody say that. You can take it away from your estate tax exclusion, but doing it properly.
Exactly. Now, years ago, I remember when my parents were setting up a trust, the exclusion was $600,000 per person. So a lot of times people had to set up a fancy trust so that they can retain, if one of the spouses died, each of the $600,000. But now it passes on to the other spouse. So technically, mom now can still pass $27 million plus to her kids if she dies.
even though the husband passed away, so you can combine those. But one of the reasons we started on the top of the segment was legislative risk. There is conversation that, in fact, this is one of those things that is also set to sunset in 2025. Not the tax ruling, but the amount of the estate tax. The discussion is that this could be cut nearly in half.
Well, it might even go down to, say, $5 million. Okay, so there are ways to mitigate even the estate tax, which I believe is at least 40%, used to be 55%. So whatever above that exclusion rate was taxed at, say, 40%, right? So a real example, I had somebody, they had 20-something million back a few years ago when, the limit was maybe 10 million per person. So they had potential of at least, 5 or 6 million getting hit by 40% tax when they die. So wisely, they thought, they set up this life insurance policy for 4 million to give the kids money to pay the tax. The problem was they didn't set the life insurance up in a special irrevocable trust, which would kept the 4 million outside of the estate. So they raised their estate by 4 million. So 1.6 million of that 4 million will go to Uncle Sam instead of to the kids. So there's some fancy ways, even if you have a very large estate or you're worried about Uncle Sam dropping the limit to 5 million per person or 3.5 million a person, because that's another way to raise revenue for the government, right?
Yeah.
So if you're worried about that, there are some ways to mitigate that risk of the estate tax. A lot of people we deal with, the ordinary people, as I call it, they don't have that problem. But if the ones that we've helped that do, there's certainly easy ways to basically pay the tax with tax-free dollars.
Dale, thank you so very much for having these frank and open conversations, and in fact, how you help people. And I just want our listeners to know this is a totally unscripted program here. So when we're looking for numbers or trying to remember things, this is just where the conversation goes. It's totally unscripted because it's fresh, and we want to talk to you, our listeners, about how Dale inside the offices can help folks like you. The theme of this month seems to be you don't know what you don't know. And if you're unaware of tax risk in your portfolio, if you're unaware of the legislative risks of your portfolio, and of course, the ups and downs of the markets of the portfolio, folks, you can get a review right here. Call 833-856-1382. That's 833-856-1382. Get started on your own retirement plan. Let us help you see the blind spots in retirement. There's no cost to sit down with Dale and his team. Thanks so much for listening. Or if you want to write Dale directly, you can write him at dale@sutis.com, or just go to the website, SOUTAS.com. For Dale Sutis, I'm Spike Spangle. We'll be back next week.
As a valued radio listener of Retire Your Way, Dale and his entire team of retirement professionals invite you to schedule your very own complimentary retirement plan review session. 833-856-1382 is the number for you to call. If you don't have a retirement strategy mapped out that includes low-fee investment elections, tax minimization strategies, decumulation plans that will last as long as you need them to, then call for your very own retirement review session, complimentary for our valued radio listeners. Are you able to lower your taxes in retirement? Are you unclear about your Social Security, Medicare, investment fees and risk, or how to produce guaranteed lifetime income so your lifestyle and goals don't have to be changed with the ups and downs of the market or taxes? Call Dale Sutis with Sutis Financial and be confident you can retire your way. Schedule your own comprehensive and complimentary retirement review session. Don't just live in retirement, thrive. Call 833-856-1382. That's 833-856-1382.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal and tax advisor to be sure a Roth IRA conversion fits into your planning strategies.